It's Friday, 1st of November, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Neil's out this week, so in lieu of our usual catch-up on macro and markets, I've got an exclusive extract from our recent online client briefing all about what to expect from the coming week's US election. Before we get to that, though, the UK budget has created quite a few waves in markets. Gilt yields off a little bit as I'm recording Friday mid-morning London, but the 10-year yield is still up more than 20 basis points since Rachel Reeves sat down post-statement on Wednesday. To find out what's going on and what comes next, I had a quick chat with Ruth Gregory, our Deputy Chief UK Economist. I started by asking her whether what was happening in markets reflects the idea that Rachel Reeves had been too ambitious in the plans she outlined to tax and borrow to boost UK growth.
Well, I think we have seen gilt yields rise quite sharply, haven't we, since Wednesday's budget? And I think maybe some of the market jitters are understandable. We and most others had expected a rise in borrowing of around 15 to 20 billion in 2029-30. And in the event, the Chancellor unveiled a net fiscal loosening of almost double that, so around 36 billion or 1.1% of GDP. And I think the OBR wasn't overly generous with its assessment of the boost to the economy's GDP growth prospects from that extra borrowing. And then in addition to that, investors are also concerned that Reeves will soon be back for more. So if she wants to prevent spending falling in every government department in real terms, for example, then she'll have to spend a further 7 billion in 2029-30. And if that's debt funded, then that would take the total rise in borrowing from 36 billion to 43 billion. So that would be broadly in line with the 45 billion of borrowing that we saw in the 2022 mini budget. So I think the market jitters are perhaps a little bit understandable. Investors are clearly nervous about the UK fiscal outlook. But I don't think this is the start of another Liz Truss style scenario.
Okay, so this is going on across DM governments and bond markets, this unease about the amount that's being borrowed, and this is being reflected in bond yields to some extent. But to your point about this not being another Liz Truss moment, and the OBR was looped in this time, and the strategy was very much on the government's part about driving home that this is a fiscally credible plan from a fiscally credible leadership. But all that being said, if gilt yields, and I know they are down as we're speaking a bit on Friday, but could a further rise in yields crimp the government's borrowing plans?
Yeah, I mean, as you say, I don't think we can entirely rule out the possibility of rapid rises in gilt yields and that triggering a self-reinforcing cycle of margin calls and further price falls. But, you know, there are reasons that you just spelled out why we don't think this is the start of a 2022 style meltdown, not least because, as you said, the Truss government jettisoned the fiscal rules, the OBR's forecast, it questioned the independence of the Bank of England. The new government has set out a tougher stability fiscal rule and a gradual shift to 3-year rather than 5-year rolling fiscal targets. And I think the economic and political circumstances are much less conducive now to a bond market panic than they were in 2022. You know, if you look at back then, inflation was high and still rising. The Bank of England had, for example, increased interest rates by 215 basis points. Inflation in the UK now is 1.7%. The bank's already started its easing cycle. But I think if gilt yields were to continue to rise, then clearly that would have implications for Reeves' scope to borrow. I think the big lesson from all of this is that, you know, in an era of where interest rates are no longer close to zero, markets are much more sensitive to higher borrowing. And that suggests that if Reeves does want to borrow to spend further, then the increases in tax that we've seen in this budget may not be the last.
Yeah, it's striking. I mean, the communications push that front ran this budget statement, and yet we still have this reaction in markets, and it's not comparable to what we saw in 2022, but it is still striking that we did get that move in yields. But speaking of, and you did mention the Bank of England, this move in yields, to what extent does it reflect the idea that because of this budget, the Bank of England may not take rates as low as had been previously expected? So this is just a repricing in the market of those expectations.
Yeah, that's right. I think if you look at the money market, they're pricing out roughly 125 basis point interest rate cut since Reeves' announcement. However, the combination that we're seeing, or we have seen, of rising gilt yield and a fall in sterling does suggest that the risk premium attached to UK assets has risen. So if you look at sterling, that's weakened a bit against the dollar and the euro. So that does highlight the fact that, yes, we have seen a net fiscal loosening compared to previous plans, and that is likely to mean that interest rates fall. Perhaps GDP growth is a little bit stronger and interest rates fall a bit slower. But there is this sense too that investors are becoming a little bit more nervous about the UK's fiscal outlook as well.
Thank you, Ruth. I can't let you go without asking about the next Bank of England decision. It's coming this Thursday. What are we expecting? And given the acceleration in rate cuts that we've seen among some DM banks, given we're now forecasting the ECB is going to speed up its pace of easing, do we expect similar from the Bank of England?
Yeah, I think the Bank of England will almost certainly cut interest rates for the second time in this cycle from 5% to 4.75% at its meeting on Thursday. But we think it's unlikely to hint that it intends to quicken the pace by cutting interest rates again at its following meeting in December. So we do think there's some valid reasons for the bank to move a bit slower than the ECB and the Fed, including the policies that we've spoken about in the UK budget. However, we still think that rates will eventually fall to 3%, so that's below the 4% currently priced into the markets.
That was Ruth Gregory on the UK budget, the Bank of England, and what comes next. Now, on to the coming week's main event. Maybe you're telling yourself you've had your fill of the election already, but this clip from one of our recent drop-ins, that's one of our short-form online briefings, touches on some of the key things you do need to be thinking about ahead of Tuesday's voting, from the economic impact of mass deportations to how the renminbi could respond. In this extract, you're going to hear Chief Asia economist Mark Williams talking to Stephen Brown from our North America team, from Ariane Curtis from our global team, and from Jonas Golterman from Markets. And it starts with Stephen on Kamala Harris's fiscal policy proposals.
There has been quite a lot of discussion about the potential for a fiscal expansion under Harris. But really, when you dig down into the policies she has proposed, such as, for instance, expanding child tax credits, funding that by raising the corporate tax rate, for example, many of those policies are just the ones that Joe Biden has set out for the last 4 years in his own presidential budgets. They haven't been passed because there hasn't been enough congressional support. Our assumption is that Harris, if she does win, then she's probably going to lack the same sort of support. So really, we're treating a Harris win as just maintaining the status quo. We wouldn't really necessarily change our economic forecast unless the Democrats did a lot better in Congress than kind of looks likely at the moment. Obviously, where it gets a lot more interesting is under Trump. So there's really, I guess, 3 key areas here. So the first is tariffs, and then it's fiscal policy, and then immigration. So I think certainly for purposes of this kind of global focused preview, tariffs is going to be the big one. We've originally had about a 10% universal tariff and then a 60% tariff on China specifically. In the last couple of weeks, Trump has given us new numbers, maybe a 20% universal tariff. Even higher tariffs on China have been touted. We've heard proposals for tariffs of up to 200% on motor vehicle imports from Mexico in particular. I think the one thing is clear is that Trump's going to put some tariffs on in some form, and his ability to do that isn't actually that limited by Congress. So that's kind of almost a certainty at this point. With regard to immigration and fiscal policy under Trump, again, our sense isn't that there would be a kind of a fiscal loosening, rather that if Trump does put some tariffs in, then that revenue could be used to, for example, reduce corporate taxes. And immigration is the big unknown. So Trump probably would try to tighten the limits on new immigration into the country, but the uncertainty would be with regard to trying to deport undocumented migrants. So there's estimates suggest there's about 13 million undocumented migrants in the country. Maybe 8 million of those are working. It's a sizable share of the labor force, even if many of those might be in the kind of more informal labor force. So if Trump were to follow through with trying to deport those people, there could be a pretty sizable impact on labor supply and also a bit of inflationary implications.
So we're talking about, you say tariffs, higher tariffs almost inevitable, loose fiscal policy, supply side restricted, potentially by lower immigration. Presumably this means that you said higher inflation, higher rates as well, stronger dollar. Is that the general Trump picture?
Yes, exactly. So on growth, I mean, we suggested that the original tariff proposal, so 10% universal, 60% on China, could result in a hit of 1.5% of GDP. Now, that is the upper limit. It doesn't mean that GDP would fall by 1.5%. It's just that growth would be a lot slower than it would otherwise be, given that potential in the US is at least 2%, maybe closer to 3% at the moment. And even that assumption does assume that that tariff revenue is used to reduce the fiscal deficit, when in reality, Trump probably would try to use at least some of that revenue to be recycled into kind of supporting growth elsewhere. So that's the upper limit. But I mean, the inflationary impact is clearer. Again, we've suggested maybe 1 percentage point on inflation from that 10% universal tariff, maybe another 0.5% from the tariffs on China. And there's a bit of debate about what that would mean for the Fed. So, for example, in theory, it's just a one-off boost to the price level. A central bank doesn't necessarily need to respond. But in reality, companies, I mean, a good example is just if we look back historically when Trump put import tariffs on washing machines, domestic producers put their prices up by just as much as the tariffs. And obviously, we've just gone through this high inflation period where companies are very cognizant of the pricing power they do have. So our assumption is that the Fed would have to respond to prevent that initial boost to prices becoming kind of ingrained in inflation. So we've kind of suggested the Fed would have to keep its policy rate about 50 basis points higher than it would otherwise be, with obvious implications for the Treasury yields and the US dollar.
Great. Thank you very much, Stephen. Right, on to thinking about the financial markets spillover. Let's stay with sort of markets close to the US to start with, Jonas. Maybe we can roll back and again think about, we're talking about two scenarios, obviously. What do you think is the difference for financial markets in the US between the two presidential outcomes?
Like what Stephen said is basically that Harris is a continuation of the status quo. So we kind of know what that would look like, especially if she doesn't get a majority in Congress, which it doesn't seem particularly likely that she would. The Senate seems to be slipping away from the Democrats, judging by the polls. So we kind of know what that will look like. It's not dramatically different from what we have. It probably means that the Fed keeps cutting, yields come back down a bit in the US, and the dollar probably weakens a bit. As for the equity market, it's got a very strong tailwind right now from, well, both the economy doing quite well and from the hype around AI. Would expect that to continue. Now, Harris has said she wants to raise the corporate tax rate back to where it was before the Trump tax cuts in 2017. That would obviously be a sizable negative for the US stock market if it actually were to happen. But I think it seems quite unlikely that the Republicans definitely wouldn't let her do that if they control the Senate. And frankly, even if she had a very thin majority, it might be difficult to get that through. So most of the sort of change that you could imagine happening after the election comes in the event of a Trump win. And in that scenario, we're talking about higher tariffs, possibly more fiscal, and the stuff about immigration, which I think the market is kind of parked for now, hasn't really focused on because it's kind of difficult to judge what exactly would happen there. But we know what tariffs do, and we know what fiscal do. In particular, we know what it looked like in 2016 through 20, and it means higher yields in the US. It means a stronger dollar, and it probably, for the equity market, I mean, Trump has said he wants to cut corporate taxes. That would be a big boost. It certainly was back in 2017. But I think the balance of risks for the US equity market now is maybe less favorable, even in the Trump scenario, because you do have that potential positive of lower corporate taxes. But the tariff stuff is much more dramatic now. The numbers are much larger, so you can imagine a bigger headwind from that side of things. And also, I think market is now worrying about the fiscal situation in a way that it was not 8 years ago, just because the starting position is so much worse in terms of the deficit and the level of debt. And this idea that you could see quite a sharp sell-off in the bond market, and that feeding through to other assets as well.
We've had a few questions on exchange rate implications. So specifically, we've had a couple on what it means for the euro, dollar euro, and also renminbi. So should we talk about Europe first of all? So maybe start on the exchange rate, and then Ariane, I'll bring you in if you've got any thoughts on implications for the European economy.
Yeah, so I think for the euro and for exchange rates more broadly, the two main impacts are what happens with tariffs and what happens with fiscal. Now, obviously, we know that higher tariffs tend to be offset by a stronger exchange rate. That certainly is what happened in 2018-19 during the US-China trade war. You'd imagine something similar would happen if there was a universal tariff imposed on all US imports. Then the dollar would appreciate, maybe not to the full 10 or for that matter 20%, because there is a degree of substitution effect going on. And also, we don't know what counter tariffs others would put in. Those obviously would offset in terms of the exchange rate impact. And then, of course, you also have the fiscal side of things and the fact that the Fed will be cutting less by less in the Trump world than he would under a Harris scenario. That's an additional. There's a bit of double counting there because obviously the tariffs is part of why Fed would have to be more hawkish, but that is an additional factor. So I think for the euro, I mean, we're at 108 now, so building in some chance. I think that there has been a shift partly on account of Trump's odds improving, but I think you definitely see 105 in fairly short order just on the expectation of tariffs coming in. Then next year, when Trump actually takes power and we sort of see what actually happens, one thing to bear in mind throughout all of this is that there is a pretty big gap. There was, at least in his first 4 years, between what Trump says and what Trump actually does. He talks very big, and then the actual impact tends to be more medium-sized, if you will. But if you do see the universal tariff, you could potentially see the euro-dollar rate back towards parity, actually, with the very hawkish Fed and tariffs. So we'd have to reassess if he were to win, but that is quite a strong possibility in my mind.
So, Ariane, how does this all kind of pan out? I guess we've got continuity Harris. That's the kind of easy question of what that means for Europe or the rest of the world. But the interesting one is Trump and tariffs. What do you think that does to Europe? And we've had a question on how we think that Europe might respond to tariffs. I don't know whether you have any views on that as well.
Yeah, so really tariffs would impact the outlook for Europe for the next few years somewhat, but we don't actually think it would necessarily have a huge impact. So we've done some calculations and we estimate that the impact on the Eurozone and the UK economy from tariffs would be pretty small, at less than 0.5 percentage point of GDP in the Eurozone, and potentially even smaller actually in the UK. And that's less than other estimates that you might have heard from the ECB, for example, where they said the impact could be 1% of GDP. So that's because if we look at the direct impact from tariffs, if they were 10% tariffs, then it would probably only weigh on GDP about 0.1 to 0.2 percentage points. And that's because the value added of Eurozone exports to the US make up less than 2% of GDP. It could still hurt some economies a bit more within the Eurozone. So Germany in particular, since the US is a bit more of an important export market for them, they would potentially feel bigger impacts. But the other reasons that we would think maybe the impacts won't be that big is because these would be universal tariffs. So it might actually not have that big an impact on demand for Eurozone exports because US importers wouldn't be able to necessarily substitute to exports from other countries, which would be cheaper. And as Janice mentioned, if the dollar appreciated relative to the euro, then this would partly offset the impacts as well. And of course, there's also the possibility that Trump would just use tariffs as a means of getting some concessions from Europe. And in the end, tariffs aren't actually implemented and other negotiations are made instead. Of course, there is the possibility also that the Eurozone retaliates, and I think we would expect some degree of retaliation. That being said, this could at least still impact inflation somewhat so in Europe. So if the currency is weakened versus the dollar and that boosted imported inflation, and if Europe retaliated with tariffs on US imports, then this could all add to inflationary pressures, at least in the near term. So there would still be some impact.
You've had lots of questions the past few weeks, and we've had a few today on China side of this. Should we start, Jonas, on markets? So you sort of spelled out a picture of the path maybe for the euro if Trump wins. Can you tell me what happens on the day after the election? What happens on the 6th of November if Trump has won to the renminbi?
Oh, I think it weakens quite a lot. I mean, the same logic applies, obviously, to the renminbi as to the euro and other currencies. It's just that the tariffs that he's talking about when it comes to China are much, much larger, 50, 60%, right, on top of the tariffs that already exist. So it's really hard to see how the renminbi weakens enough to offset that. You can see about 10% depreciation of the euro, and that, as Ariane said, that kind of evens it out. If the renminbi were to fall, 50%, I don't know what that world looks like. It's kind of crazy, right? So I think, from a factor point of view, what happens the day after if Trump wins is probably the renminbi goes from about 7.10 where it is now to 7.3 or so. So that's about 3% depreciation. So nowhere near enough to offset the sort of implied tariffs. But the reason I think it stops there is that the PBOC has made it quite clear they don't like exchange rate volatility, and 7.3 is the level that they have enforced the sort of a cap on the dollar renminbi exchange rate over the past few years. So I think the initial reaction for them would be just, okay, let's just freeze this here and then we'll wait and see what actually happens in terms of, is this all a negotiation ploy? Does this actually take, it's come into force quite quickly in the first half of next year, at which point, if it did, you would assume that PwC has to let the renminbi weaken further because the pressure from the market would be quite significant. And also they would want to offset the impact on their exports, obviously. But a 50% depreciation of the renminbi would lead to two problems for the PwC or the Chinese more broadly. One is you have potentially large capital outflows from China, which is something they've seen in the past and are really worried about because it would undermine their financial stability. So that's one reason they keep the exchange rate on a leash quite tightly and would probably continue to do so. So it would be a managed depreciation, not sort of market-driven one in the way you would see with, say, the euro or the yen. And the second reason is if the renminbi depreciates, well, never mind 50%, 10, 20% against the dollar, but other currencies don't fall as much, then the renminbi has weakened quite a lot against its competitors, the euro, the yen, other Asian currencies, and so on. It's already quite weak from a historical perspective, and China's trade surplus is already very large, and other countries are not happy about that. If you try to offset US tariffs on China by exporting even more to the rest of the world will basically say, no, thank you, that they would have to weaken their currencies and or impose tariffs on China in response. So I think that the situation for China is quite different from Europe. The 10-20% tariff is manageable. 50-60% one for China, it leads to quite sort of dramatic financial implications. And then we don't really know. We'd have to see what the sort of second round effects as that game continues would be. So I think you're not too worried about Europe, but I think the renminbi dollar question is potentially much more problematic.
Thanks. Following up on from that, we've had a couple of questions about the impact on China of tariffs. So we've had one saying that exports to the US are only about 2 or 3% of Chinese GDP. So could we be overestimating the impact of a 6% tariff? And we've had another question in advance saying that there doesn't seem to be too much concern in China about the potential of tariffs. Also, suggestions that many in China would prefer a Trump than a Harris win. So I can sort of bundle those together. I mean, it's certainly true that China's leadership doesn't like uncertainty, doesn't like instability. So a Trump win would be a little bit alarming in that sense because you never know exactly what you're going to get. And there would be a damage to China's economy from a 60% tariff, obviously. But the question we've got pointing out that exports to the US are only 2-3% of GDP, that's absolutely correct. I think it's 2.8% of GDP, the gross value of exports to the US last year. It's not really that big. And if you bear in mind that not all of that is going to disappear, even if you put on a huge tariff, because there just aren't alternative producers. And a lot of these things are things that American consumers are still going to buy, even if they end up being more expensive in the shops. So I think it is easy to overestimate how much China's economy is dependent on final demand from the US. And as Jonas is saying, one factor that China's leadership will be thinking about in all this is how their response plays with other economies. So if you have Trump essentially kind of turning the table over the global order, putting massive tariffs on, in some ways that plays in China's favor, and China won't want to lose that advantage by then doing a huge competitive devaluation that would annoy the Europeans, for example. They'll want to present themselves as the ones that are kind of protecting the global order. Another element to all this, in why I think some in China think that Trump might be easier to deal with, is that they learned during the first Trump administration that Trump likes to do a deal. If we remember the phase one trade deal that China did, it committed to a lot of things. A lot of them it didn't actually follow through on, but that succeeded in neutralizing the threat of further tariffs. And I would imagine that in Beijing that there are people right now trying to think of what is the offer that we can give? What's the deal that we can make? And maybe there's some things in there that China can get that it wants in response, if it can credibly offer to do something to reduce the bilateral surplus that it has with the US. So I think Trump is a manageable challenge. What we've seen over the past 4 years with Joe Biden, we assume that Harris is kind of continuity Biden in that sense, is something, fewer surprises, but is continuing constriction of China's ability to access high technology, the stuff that it wants. which has really been helped by the way that the US has been able to get allies on board. So in many ways, I think that is more challenging. And that, I think, is why a lot of people in China actually feel that Harris would be more challenging over the medium, long term than Trump.
That was Mark Williams on the view of this election from Beijing. You also heard from Stephen Brown, Ariane Curtis, and Jonas Golterman. The full recording is available to Capital Economics clients, and I will link to that in the podcast notes. Clients are also invited to join our Economist briefing on Wednesday, 6th of November, to ask questions and hear from the team about what we know so far about the races, the response in financial markets, and what to expect in the days and weeks and months ahead. I'll add a sign up to the show notes as well as a link to our dedicated US election page where you can find all the key macro and market analysis around this crucial vote. Neil will be back next week and we will have plenty to get into as well as the election results so far. We've got that Bank of England decision that Ruth was talking about, but also, dare I say it, another hotly awaited statement from the Chinese government about its fiscal stimulus plans. Until then, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.